Welcome, viewers. This is Principles of Accounting 2, fall of 2013, and we're doing a quick test question here. This is a typical test question. It appeared last spring, which means I also used it for the summer, on a test. Most people get this type of question wrong, yet it's very typical for an accounting test. So it's I think if I walk you through it, it should be it's one of those where you get it wrong and then you see how it's done. You go, ah. So let's talk about this question here. You've got a fry company. They produce model aircraft, and it sells for $150 per unit. The $150 per unit, we're talking about right here, is what we call a sales price, right? Because that's the price that it sells for. Okay, so then they say, estimated costs are as following. Sorry, okay, got distracted for a second there. So what do we have? We have some variable production costs per unit. We have direct labor costs per unit. Oh, I'm sorry, this is the heading. Variable production costs per unit. So right there it's telling us these are variable costs. You have direct labor, you have direct materials. These are unit costs, so for each unit it's going to be 50, 25, both variable. Down here we've got variable sales commission. So what confuses a lot of people is there's a blank spot here. Blank spot doesn't really mean anything, it's just an eye break. So your variable sales commission, a lot of people struggle with whether or not variable sales commission is variable or fixed. It's variable. And the other place where people struggle with is 10% of sales price per unit. A lot of students don't know what that means or what to do with it, so we'll walk you through that in a second. Okay, a couple more line items here in this table. We have total fixed production overhead. Now these are total, where these up here are per unit. So make sure you keep those straight, otherwise you get really odd numbers. So you got total fixed production overhead, total fixed administrative salaries. So if you remember from chapter 1, we have production and we have administrative. Those are those line items there. And total fixed sales department salaries. So we have three numbers here. So ultimately what we have is we have three types of variable cost and three types of fixed cost, and then we have M&Ms. Good, chocolatey. And then we have a sales price up here. So the first required question is calculate the contribution margin per unit. So again, if you don't know what contribution margin means, you're going to be lost. If you don't know what a unit is, you're going to be lost. But let's go ahead and go through this, right? We know sales price. I'm going to try to draw this. This could be a disaster. But your sales price is $150, right? And to get the contribution margin, and that's per unit. How do I know that? Because it says it sells for $150 per unit. So then you subtract the variable cost per unit. We have a couple variable costs per units, right? We have $50, which is your direct labor cost per unit. We have $25, and a lot of students that get this question wrong stop there. Some students just get the 50. And then we have, and that's of course right there. Now we have this variable sales commission. We know it's a variable cost because it says variable, it's a commission. Some people don't know what a commission is. So if you sell something, let's say you're a salesperson, and you sell one unit for $150, you have a $150 sale. You get paid based on that sale, typically a percentage of that sale. So here it says a commission is 10% of the sales price per unit. We know you have $150 times 0.10, which should, hopefully, if I'm doing this right, mean a $15 sales commission. So every time something's sold, there's a $15 commission, which is great if you're the salesperson. If you're the company, that's a cost. So 15 goes down here, and that happens to be all your variable costs, right? We have variable cost, variable cost, variable cost. All of these are in units, right? None of these are total, which means your contribution margin per unit is simply your sales price per unit minus your variable cost per unit. And hopefully I can subtract these. Let's see, 150 minus 50 is 100. That's going to be 75, 70, 65. Let's go for 65. Is that right? Boy, that does not feel right. I think it's 60. 150, 100, 75, 60. It's 60. So that is part one. Now I'm going to go put this on pause, clean up the screen a little bit, and double check my math. Be back in a second. Welcome back. I just checked my math and I'm corrected. It's 60. Yay, I can subtract. Just wanted to let you know, when you're doing a test like this, you clearly don't want to be red ink all over the table. But what you want is, you want to show your work, right? I clearly see here that a student would be taking a sales price, subtracting this line item, this line item, this line item. I see here there's some calculation, so at least the person knew. So let's say that, you got all the way there and you did end up with $65. And it makes everything else wrong. You're only going to lose a point or two, or maybe 40, but you won't lose full credit because this is clear. Versus what a lot of students do is they would just put a number in, right? Like 70, that's wrong. And I have no idea where that number came from. And let's say they put a random number down here, and maybe their logic's right, but I wouldn't know that because I just see a number. Then you lose all your points. Okay, so remember the number 60 for a second here. So we know from prior calculations, that's a 0 by the way, that the contribution margin per unit is 60. Part B, calculate the company's break-even point in units and total sales dollars. The easiest way to do that is to take the fixed cost. We're going to use the contribution margin per unit method over the CMU. You could use the equation method, but this is fast. We already know what the CMU is because we just calculated it. That's 60, contribution margin per unit. So then we have to figure out the fixed costs. The fixed costs, you can take 50,000 plus 30,000 plus 10,000. That should be 90,000. And that's going to equal something. I'm going to go ahead and pull out my old calculator, free from, actually I can't even say who it is because it's the competitor. And I get 1,500 units. Now, like I said, I have a free calculator, so I'm going to make sure I did that right. 90, 1, 2, 3, divided by 60, 1,500 units. Okay, I got the right number. Yay. And you want to label that units. So what this is telling us is 1,500 units is your break-even point. Well, that's great. Now, in dollars, sales dollars, what is your revenue is what this is asking. If you sell 1,500 units, you take that, you multiply it by $150, which is our sales price per unit, and you get, let's see, 1,500 times 150. I have something to the effect of 225. This is kind of where I wish I had the answers in front of me, but I don't. 0, 0, 0. Now again, cheap calculator, so let's make sure we did this right. $150 sales price times 1,500 units is 225,000. Boy, that sure does feel right. So, a couple things I'm going to do. I'm going to put you on pause for a second, and I will be right back. Welcome back. So, right now we've calculated part A, which is your contribution margin per unit of $60. And we've calculated the break-even in units and dollars. Now, if you were doing this on the test, you'd want to circle these. You'd want to label this dollars. You've clearly sort of shown your work, kind of sloppily, but again, I'm using a mouse versus a pen. And also on the test, you would have a lot more white space. You could always use the back of the paper or something like that. But now it's very clear what everybody's answers are. I'm going to go ahead and erase this real quick. I'm going to redraw these just for later in case we need them. Remember, we already calculated this stuff. You would never on a test just put the answers, but we can do this because we have a recorded version of this. And let's see what part C is asking. Oh, part C, how many units must be sold to earn a profit of $30,000? Well, we can still use the contribution margin per unit method here. Remember your CMU, you got your fixed cost plus your desired profit. In this case, that would be your desired profit. And your fixed costs are up here. So what you have, 50,000, 30,000, 10,000, 50, 60, 70, 80, 90,000. This is actually a lot more fun than it probably is for you guys at home. Plus 30,000. Divided by the 60. And that should get us, I want to say the word is 2, but let's check. 120, 1, 2, 3, divided by 60, 2,000. Let's see if I can just scroll down a little bit. Nope, I can't. Whoa. I'm going to have to pause this. That's a little crazy. I'll see you in a second. Okay, I'm back. So a couple things here. We've gone through Part A, which is the contribution margin per unit, which is $60. Part B calculated the break-even point, which we figured out is 1,500 units. And also in sales dollars, remember half the points are there, so if you miss sales dollars, you lose a bunch of points. $225,000. Part C, they're asking just for units, and we calculated 2,000 units to make a profit of $30,000. This, and there's a smiley face because I was messing around. Okay, this makes sense. Let's think about this for a second. If break even is 1,500 units, you'd have to sell more to make a profit than 1,500 units, and $2,000 is more than 1,500. It's reasonably in there, so you're probably getting the right answer just from a sanity check, right? Like if this was $1,400 units, that'd be way off. If it was 1 billion units, it'd probably be way off. 2,000 looks and smells like it would be the right answer. Now for D, so for D, they're saying sales commission. Remember sales commission? So a lot of people don't know what to do with this to begin with. They're not comfortable with percentages. Here we're changing that variable, which again would indicate that that's probably some sort of important thing to use in the equation, right? So assuming that sales commission is $20 for every unit sold. So what we're doing is we're replacing a 10% sales price per unit, which we figured out before was $15, right? You take the 150 times the 10%, you get 15 bucks. Now for D, we're saying instead of that, this is going to be $20 per unit. All right. What's the revised break-even point? So same formula as before, right? First thing we need is the fixed costs. And we've calculated the fixed costs already. If we're doing this all at once, the answer would be on here already. But it's 50, 60, 70, 80, 90,000. Over your contribution margin per unit. Contribution margin per unit is still 150 minus 75. I'm cheating a little bit with the 75. I took the 50 plus the 25 equals 75 minus the 20, which is right here. Now we know logically before it was 60 and it was 15 bucks a unit, so it should be lower, right? Let's say lower. It's going to be lower. It should be 55. I know that's a 5. Let's see, what's 95 minus 150? Is that 55? I'm going to have to pull out the calculator. Sorry, guys. It is a weekend, and it was a Broncos game last night. 55. Hey. So you take the 90,000 over the 55, which is your new contribution margin per unit. You also know 20 is bigger than 15 by $5, so it's going to be $5 less, so that all works out. Let's take the 90,000, divide it by the 55, and that gets you 1636 units. There's some decimals in there. I'm going to ignore those for the sake of simplicity, but it's 1636.36. Some instructors would say you have to do 1637 because there's no such thing as a partial unit. I'm not that guy. If you're, basically if you're anywhere close to that, you're going to be fine for me. That's how you do this type of question. It's a very typical test question. In a second, we're going to run through a different type of test question, which is equally enjoyable and fun. Welcome back. We're looking at a second very typical test question that a lot of students tend to miss. Mostly, again, with a lot of these test questions, you get all these numbers, and you may or may not have any idea what to do with these. Sometimes just the sight of a bunch of numbers in a table just cause people to freeze. This is very similar to one of your homework problems. You have two companies in this scenario. One is Frodo, one is Mary. You may recognize those from popular culture. You can blame Dr. Holt for that. And this right here you may recognize, hopefully. If not, it's a good time to panic, as a contribution margin income statement. You have your revenue minus your variable costs, giving you a contribution margin. You subtract your fixed costs, you get net income. You can find this first explained in Chapter 2, and we're going to use it a lot throughout the semester. Down here, we have some unit stuff. We have the number of customers. Now, Frodo looks like he's got 100 customers. Mary also has 100 customers. And we have their sales price, which is $150. What's nice, just so you know how this works, if it says you get $150 per customer and you have 100 customers, if you're lucky, on a good day, you should have $15,000 in revenue, which is where that number comes from. Another thing, we know if we have, let's take Frodo here, $3,000 in variable costs and 100 customers, that should be $30 of variable cost per customer. Makes sense. Now for Mary, let's see, Mary's got $9,000 in variable cost, and that serves 100 customers, so his variable cost, also known as variable cost per unit, should be 90. So if you notice, and that makes actually sense because look at the contribution margins, they're different. Net income stays the same. So this should start sounding like an operating leverage type question for you, right? You see how they're both serving the same customers at the same price with the same profit. Frodo here has very little, relatively speaking, variable costs. Mary here has very high variable costs. So then, of course, probably what's going to happen is we're going to change the product mix. We'll do that in a second. We're back. The only thing I've really done differently since I disconnected you for a second is I just wrote in the numbers that we just calculated here. The variable cost per unit, that's a VCU, although that might just look like some scribble to you, of $30 and $90, which we just calculated. Okay, let's get into the scenario. Frodo suddenly lowers his sales price to $130 per customer. Okay, that's probably important. So he's lowering his price, which is going to affect his revenue, in order to attract 40 customers away from Mary Company. That means he's now going to have 140 customers, and Mary's going to have 60 customers. 100 minus 40, right? Because he's attracting them away from, and he's getting them. So if we take that 130 times the 140, it suddenly sounds like a skit from the Californians. Let's see, like pull out my calculator. 30 times 140. We know his new revenue is 18,200. And we know Mary has 60 and 100, which is 1, 2, 3, 6,000 in revenue. Let's call it that, but let's figure out what the question's asking first. Away from Mary. Redraft Frodo's contribution-based income statement. Oh, so I don't even need this. Haha, we'll need that later. From March 2013, using a selling price of 130 and 140. Oh, it even gives us that calculation, total customers. So we have to redraw the contribution margin income statement. So we can do revenue, right? And we know this is Frodo of 1820. Right? And you know your variable costs. We're already going there. Our variable cost per unit stay 30. Our number of units are now 140. Which means our new variable costs are 4,200. Let's see if I can do that. I'm missing a 0 here. That makes sense. 4,200. Notice our variable costs total went up a little bit because we have more customers, but our variable cost per unit stayed the same. So now you got your contribution margin of 0.0084 14,000. Now our fixed cost, and this is going terribly wrong again. Hold on one sec. Okay, we're back. I apologize for that. I had to kind of erase everything and rewrite it in. We have our revenue of 18,200. Yes, that's a 2. You have our variable costs of 4,200. It gives you your contribution margin of 14,000. Is that right? Yeah, that's right. So far, so good. Now we have our fixed costs. Now a lot of people don't know what to do with fixed costs. So essentially, your fixed costs are fixed. So you have your $10,000. Right, you just carry that number over, and your net income is going to be 4,000. And you write net in here. And that's basically your contribution margin based on the new income. So he's got a bunch of new customers, and he lowered his price, and it looks like he has a 100% increase in net income, which is not a bad place to be. He was making $2,000, now he's making $4,000. We now have a second part of this problem. Now here, very similar to the first part, we're assuming Frodo's price per unit remains changed at 150. I believe, if I remember correctly from last time, their variable cost per unit's 90, right? We got that by taking the 9,000 over the 100. Okay, slowing down a little bit. And I'll actually just write in variable cost per unit here, except the C's not working. All right, clearly I went into accounting because I am not an artist. So what's happening here? Okay, so Frodo left his price unchanged at $150. Mary now attracts the 40 customers. So suddenly Mary's getting 140. And Frodo's ending up with 60. This could very easily turn into a contribution margin question, but or an operation leverage question, but we're not going there. Okay. Mary Company can contract 40 of Frodo's existing customers by reducing its own selling price to 130. So now Mary is reducing his price to 130. So now they want us to redraft, okay, the contribution margin. So very similar. We take the 130 and you multiply it by the 140. And that should give us, let's see, 130 times 140, 18,200. I'm going to abbreviate this so this video doesn't last forever. Although for some of you it may already have lasted forever. So we got a revenue. You would do this a little bit neater clearly with a pencil. Your variable costs, what are your variable costs? They are $90 times your 130, which is your number of customers. Is that right? No, that's not right. Be times 140, which is your number of customers. So what do we got? We got 140 times 90. 1 to 600. Notice this is a lot higher than Frodo's. Now why is that? Because his variable costs are higher, right? Remember Frodo's were 30, he's 90. So suddenly, this guy is in trouble, isn't he? 18,200 minus 12,600. He's got 5,600 contribution margin, which is still good. That's a contribution margin, assuming I can draw a 6. And definitely having some technical issues here. So what's his fixed cost? I mean, because that's positive, right? A positive contribution margin is good. His fixed costs are 4,000. Which means he's making a $1,600 profit. Which is okay. But remember, at the same sales level, Frodo is making a $4,000 profit. So making the same decision would be different. Frodo could undercut Merry, still be profitable, a lot more profitable. So that's how you would pretty much do these problems. Good luck on the test. It's a doozy. Study hard. Take care. Bye. One last thing before you go. I just found the actual answers, and it looks like we're pretty darn close, if not right on. Actually, we're dead on. So here's the typical answer key, just to show you how to do some of these. here is what we're looking for part A, right? Frodo lowered his price. Look at this. We got the 1820, the 4000, the 1400 contribution margin. So that's what that looks like very neatly. Let's see. I'm going to click off that real quick. I'm going to go down to part B, and we got the same thing for Mary Company. Oh, for C, I guess I didn't cover C, but the answer is operating leverage. That's all I need to put. I'll actually write that out. You're welcome to read all that rambling, but the answer that I'm looking for would be something like this. Except, again, readable. Boy, I like Excel better. AGE, operating leverage. Yeah, it looks like a serial killer wrote that.